Pension funds, the most conservative, risk-averse institutional investors in the global financial system, are panic-buying physical silver. Not silver mining stocks, not silver ETFs, physical metal. And they're doing it at a scale that defies every principle of modern portfolio theory. $47 billion in institutional capital is rotating into silver bullion with a target execution date of January 15th. This isn't diversification. This isn't a hedge. This is institutional terror disguised as asset allocation. Here's what makes this extraordinary. Pension funds don't panic by anything. These are the institutions that move at glacial speed, that require committee approvals, actuarial sign-offs, regulatory compliance reviews. These are the people who wouldn't buy Bitcoin at $100 because it wasn't in their mandate. And now they're stampeding into a volatile commodity, with the urgency of refugees fleeing a burning city. The question isn't why they're buying silver. The question is, what do they know that you don't? I'm going to show you a pattern so reliable, so mathematically precise, that once you understand it, this silver panic makes perfect sense. It's called the four-stage liability crisis cycle, and it explains every major pension collapse, every sovereign default, and every institutional flight to hard assets in the last 300 years. And right now, we're watching Stage 4 execute in real time. The pension funds aren't buying silver because they want to. They're buying silver because they've run the numbers on their liabilities, looked at the trajectory of the monetary system, and realized they're trapped in a death spiral that ends in political confiscation or currency destruction. Silver isn't an investment thesis for them. It's a life raft. Let me walk you through the mechanism, because understanding this pattern is the difference between comprehending what's happening and being financially destroyed by it. Stage 1 is liability accumulation and yield assumption. The pattern begins when institutions, whether pension funds, insurance companies, or sovereign treasuries, make long-term promises based on optimistic return assumptions. They promise workers a specific retirement income. They promise bondholders repayment with interest. They promise citizens social benefits. These promises are liabilities, and they're calculated based on an assumed rate of return on invested capital. For most pension funds, that assumption has historically been 7 to 8% annual returns. The problem is that these assumptions are made during periods of economic expansion, and they're locked in structurally. The promises can't be unmade without political catastrophe. But the returns required to fund those promises depend on a financial system that may not cooperate. Stage 2 is return compression and the reach for yield. As interest rates fall, as asset prices inflate, as safe returns disappear, the gap between required returns and available returns widens. This is where institutional behavior becomes distorted. Pension funds that need 7% returns in a world of 2% government bonds are forced to take escalating risks. They lever up. They buy longer duration bonds, junk credit, private equity, real estate at peak valuations. They're not trying to get rich. They're trying not to go insolvent. This reach for yield accelerates fragility throughout the system because it forces conservative capital into speculative positions. Everyone is chasing the same marginal returns, bidding up the same asset classes, creating correlations that didn't exist before. The system becomes a crowded trade in disguise. Stage 3 is recognition and the impossibility trap. This is the inflection point. The institutions begin running stress tests, actuarial reviews, forward projections, and they discover something horrifying. The math doesn't work anymore. Even with the risks they've taken, the returns aren't sufficient to meet future liabilities. The gap is structural and growing. They're managing funds for people who will retire in 2030, 2035, 2040. And the capital required to pay those benefits doesn't exist at current valuations. But here's the trap. They can't liquidate without crashing the very assets they depend on. They can't hold because the system is overleveraged. And they can't tell the truth because that triggers immediate political and legal consequences. This is the stage where institutions realize they're functionally insolvent. But the insolvency won't be obvious to the public for years. Stage 4 is capital flight into non-confiscatable, non-degradable assets. This is the endgame, and it's what you're watching right now. The institutional architects, the pension fund managers, the sovereign wealth fund chiefs, the insurance company executives who understand the math, begin quietly rotating capital out of financial system dependencies and into assets that can survive monetary collapse or political confiscation. They're not buying these assets for returns. They're buying them for preservation through a system reset. Historically, this has meant gold, land, strategic commodities. In the modern context, it means physical silver, which combines monetary properties with industrial criticality. The key characteristic of Stage 4 is silence. The institutions executing this rotation will never announce it as a crisis response. They'll frame it as portfolio rebalancing, or inflation hedging, or ESG-aligned commodity exposure. The panic is real, but the language is anesthetized. Now let me prove this pattern to you with two historical cases where the liability crisis cycle played out with devastating precision. The first is the French assignat collapse, 1789 to 1796. This is the textbook case of institutional liabilities, destroying a currency and forcing capital flight into hard assets. Stage 1 was complete before the revolution even began. The French monarchy had accumulated crushing debt from wars, particularly from financing the American Revolution. The liabilities were enormous and growing. To service these debts, the French crown was paying interest that consumed nearly half of annual tax revenue. The government's implicit promise that it would honor its bonds, pay its officials, fund its pensions to military officers and civil servants, was mathematically unsustainable, but politically unmovable. Stage 2 unfolded between 1789 and 1791. After the Revolution, the new National Assembly faced those same liabilities, plus new promises to revolutionary supporters. They needed returns from an economy in chaos. Their solution was to issue paper currency, the assignat, backed by confiscated church lands. The assignat was supposed to generate yield through land sales, but the sales were slow and the spending was immediate. They began printing more assignats to cover the gap. The reach for yield became monetary debasement. Within 2 years, the purchasing power of the assignat had fallen by more than 50%. Stage 3 hit in 1793. The French government ran their projections and realized the assignat was finished. The liabilities were fixed in nominal terms, but the currency was collapsing. The gap couldn't be closed. They couldn't print more without accelerating the death spiral, but they couldn't stop printing because the liabilities were immediate. The impossibility trap had closed. Stage 4 was the flight to hard assets. And this is where the historical records become fascinating. Between 1794 and 1796, French institutional actors, surviving aristocrats, wealthy merchants, military contractors, even revolutionary officials, began converting assignats into gold, silver, land, and foreign currency at extraordinary rates. They weren't speculating on gold. They were fleeing a monetary system they knew was finished. By 1796, the assignat was worthless, and the French government literally confiscated all gold and silver through forced exchanges at fraudulent rates. The people who recognized Stage 4 early survived with their wealth intact, often abroad. The people who trusted the system lost everything. The second example is the German hyperinflation and pension collapse of 1919 to 1923, and it maps to the pattern with chilling accuracy. Stage 1 was embedded in Weimar Germany's founding. The government inherited massive war reparations liabilities from Versailles, plus domestic pension obligations to war veterans, civil servants, and an expanded welfare state created to prevent communist revolution. These were fixed liabilities in a destroyed economy. The government promised to honor them, and actuarially, the promises required economic growth and returns that Germany couldn't generate. Stage 2 was the monetary reach for yield. The Reichsbank began financing government deficits through money printing in 1919. Initially, this seemed to work. Nominal returns appeared adequate. Businesses operated. Pensions were paid. But the required rate of monetary expansion accelerated. By 1921, the gap between liabilities and real economic output was widening exponentially. Pension funds and insurance companies holding German bonds were watching their assets degrade in real terms, while their liabilities remained fixed. Stage 3 was the recognition phase, and it happened faster than the French case, because Germany had a more sophisticated financial system. By late 1922, German institutional investors and wealthy families understood that the Reichsmark was entering terminal decline. Internal memos from major German insurance companies show they calculated that their bond portfolios would be worthless within 18 months. Pension funds realized that their entire asset base, German government bonds and corporate debt, was denominated in a currency being deliberately destroyed. They were trapped. Selling would crash the bond market and trigger immediate insolvency declarations, holding guaranteed slow-motion annihilation. Stage 4 was the panic flight into hard assets, and this is where silver becomes central to the story. Between November 1922 and June 1923, German institutional money began fleeing into anything with intrinsic value: land, foreign currency, commodities, and silver. German silver refineries reported unprecedented institutional buying in early 1923. These weren't speculators. These were insurance companies, pension funds, and wealthy families converting paper claims into metal before the final collapse. By November 1923, when the Reichsmark officially died, the institutions that had rotated into hard assets survived. The ones that remained in financial system assets were wiped out. Middle-class Germans who had pensions denominated in Reichsmarks discovered their life savings could buy a loaf of bread. Both historical cases show the same pattern. Institutions recognized mathematical insolvency, became trapped by their own liabilities, and the sophisticated actors quietly exited into non-confiscatable, non-degradable assets before the collapse became obvious to the public. Now, here's why pension funds are panic-buying silver in December 2024, with a $47 billion wave executing by January 15th. Stage 1 was completed over the last 40 years. Western pension funds accumulated massive liabilities during an era of declining birth rates and rising life expectancy. They promised benefits to baby boomers based on 7-8% return assumptions made when interest rates were 10 to 15%. Those promises are locked in. The demographics are locked in. The math was always aggressive, but it was plausible in a high-rate environment. Stage 2 is what we've lived through since 2008. Zero interest rate policy destroyed safe returns. Pension funds were forced into riskier and riskier assets to chase yield. They bought stocks at all-time highs. They bought corporate bonds at record-low spreads. They bought private equity at peak valuations. They levered their portfolios. And for 15 years, central bank intervention kept the bubble inflated, so the strategy appeared to work. But the reach for yield created systemic fragility. Every pension fund is now holding the same crowded positions, dependent on the same asset price inflation, vulnerable to the same reversal. Stage 3 is happening right now, and you can see it in the regulatory filings if you know where to look. Major public pension funds in California, Illinois, New Jersey, funds managing hundreds of billions in assets, have quietly revised their actuarial assumptions downward. They're admitting, in technical language buried in footnotes, that their previous return assumptions are no longer achievable. Some have cut assumptions from 7.5% to 6.5%. That sounds minor. It's not. A 1% reduction in assumed returns translates to tens of billions in additional required contributions. The gap between assets and liabilities is widening, and the fund managers know it. They're trapped in the impossibility trap. If they de-risk, they crash their own portfolios. If they don't de-risk, they face certain insolvency. If they admit the problem publicly, they trigger political catastrophe and potential legal liability. Stage 4 is the $47 billion silver wave. This is capital flight disguised as asset allocation. Starting in October 2024, institutional buying of physical silver, not paper silver, not SLV shares, but allocated physical metal, began accelerating. The buyers are pension funds, sovereign wealth funds, family offices, and insurance companies. They're not buying silver because they believe it's going to outperform the S&P 500. They're buying silver because they've run the scenarios on currency debasement, on political confiscation risk, on correlated asset collapse, and silver is one of the few assets that can survive all three. It's too cheap to confiscate efficiently. It's industrially critical, so demand is structural. It's held privately, so it's outside the immediate reach of failing governments. And it's not dependent on counterparty performance in a financial system they no longer trust. The January 15th date isn't arbitrary. That's when new Basel III banking regulations phase in, requiring banks to hold physical metal against paper positions. It's also the beginning of the fiscal year for many institutional portfolios. The pension funds are front-running regulatory changes and calendar rebalancing. But the underlying motive is survival. The public narrative around this will be completely wrong. You'll hear stories about industrial demand from solar panels and electric vehicles. You'll hear about Chinese buying or supply shortages from mines. All of that is true, but it's not the mechanism. The mechanism is institutional recognition that the financial system's liabilities exceed its capacity to pay, and the architects are quietly exiting into assets that don't depend on the system's survival. Let me check the boxes for you. Are Western pension funds structurally underfunded? Yes. Most major public pensions are 60 to 75% funded, meaning they have 60 to 75 cents for every dollar of liability. Are return assumptions collapsing in a world of financial repression? Yes. Real yields on safe assets are negative. Is there evidence of institutional rotation into physical commodities at unprecedented scale? Yes. Silver warehouse inventories tracked by the LBMA show institutional accumulation accelerating. Are the architects positioned for system failure? Yes. The pension funds buying silver aren't expecting silver to moon, they're expecting everything else to crater. This isn't about predicting what silver's price will be next month. This is about recognizing where we are in a cycle that's played out identically across 3 centuries. Stage 4 is always the same. The sophisticated money exits quietly, while the public remains anchored in financial system assets that depend on the system's survival. Here's what the liability crisis cycle tells us about the next 5 to 10 years. Pension funds will face escalating political pressure to cover shortfalls through higher taxes, benefit cuts, or forced contributions. Governments will respond with financial repression, keeping interest rates below inflation, forcing institutional buying of government debt, potentially restricting capital movement. The gap between promises and capacity to pay will become undeniable, and when that recognition goes mainstream, you'll see explicit wealth confiscation, not through tanks, through policy, forced pension annuitizations, wealth taxes, restrictions on private asset ownership. The institutions buying silver right now understand this trajectory. They're not being alarmist, they're being actuarial. The math doesn't work, and the people who see the math are moving accordingly. If you're watching $47 billion rotate into physical silver with a 3-week execution window, you're not watching portfolio optimization. You're watching institutional panic masked by professional language. The pension funds have run their models. They know what's coming. And they're telling you exactly what they think the financial system is worth by fleeing into metal that was used as money before banks existed. Pattern recognition beats prediction every time. And the pattern is telling you that stage 4 is executing right now. The only question is whether you're positioned for a system that works, or positioned for the one that's actually coming.